Gold is stuck right now, but what happens next could catch most traders completely off guard. Because if you just look at the chart, it feels like the market is doing nothing. And if you only follow the news, you're already too late. But when you understand what's happening beneath the surface, the entire picture starts to change. As of April 8, 2026, gold is trading around $4,680 per ounce, with a daily range roughly between $4,650 and $4,700. At first glance, this looks stable, almost quiet. But markets are never truly quiet. What you're seeing right now is a setup. So the real question is, why isn't gold moving higher? The answer is pressure. Right now, the US dollar is strong. And whenever the dollar strengthens, gold tends to struggle. But let's break this down properly, because this is where most people misunderstand what's really going on. Gold doesn't produce income. It doesn't pay interest, it doesn't generate yield.
So, when interest rates are high, investors naturally prefer assets that actually pay them, like bonds or savings instruments. That shifts capital away from gold. And right now, the market still doesn't have a clear signal that rate cuts are coming anytime soon. That uncertainty is keeping pressure on gold in the short term. But here's where things start to get interesting. If everything looks bearish, why isn't gold falling aggressively? Why isn't it collapsing? This is exactly where most traders get trapped. Because markets don't move in straight lines. They don't simply go up because the news is positive or go down because the news is negative. Instead, price moves toward areas where the most orders are sitting, where stop losses are stacked, where liquidity exists. And once price reaches those areas, something happens. It reacts. That's why you often see price move down, then bounce, then drop again, and then suddenly reverse in the opposite direction. To most people, that looks random, but it's not. This is not random movement. It's a structured process. Before any strong move happens, the market usually clears out weaker positions first. It forces early buyers out. It forces emotional sellers in. And only then does the real move begin. Let me explain this with a simple idea. Imagine a scenario where most traders are expecting gold to go up. They start buying early. Now, if the market moves slightly down, those traders begin to panic. Their stop losses get triggered. That creates liquidity. And once that liquidity is collected, the market has room to move higher. This is why timing matters more than direction. And this is exactly the type of behavior gold is showing right now. Now, let's add another layer to this, the bigger picture global uncertainty. Right now, geopolitical tensions, especially in the Middle East, are still creating instability across financial markets. And whenever uncertainty increases, investors look for safety. They look for assets that can hold value during unstable times. Gold has historically been one of the strongest safe haven assets. So, even when short term pressure exists, there is still underlying support, and that creates a conflict. On one side, you have a strong dollar and high interest rates pushing gold down. On the other side, you have fear, uncertainty, and long term demand holding it up. That's why price is not trending clearly in one direction. It's balancing between forces. But there's something even more important that most people completely ignore. Large institutions and central banks are still buying gold consistently, not for short term trades, not for quick profits, but for long term positioning. They are not reacting to daily headlines. They are positioning based on long term economic shifts. And that's one of the biggest reasons why gold is not collapsing, even when short term conditions look weak. Now, the big question, what happens next? There are two main scenarios you need to watch very carefully. First scenario, if gold manages to break above the $4,700 level with strong momentum, not just a weak move but a convincing breakout, then we could see a fast expansion higher. Because once that level is cleared, there is less resistance above. Price can move quickly. Second scenario, if gold fails to break higher, and instead drops below the $4,650 level and more importantly stays below it, then a deeper pullback becomes very likely. And here's the part that most traders miss. Before the real move happens, there is often a fake move. The market might move slightly higher, pull traders into buying, and then reverse. Or it might drop lower, create panic, and then suddenly bounce. This is how traders get trapped. This is how emotions take over. And this is why patience becomes your biggest advantage. You don't need to predict every move. You don't need to guess where the market is going. You need to wait. Wait for confirmation. Wait for clarity. Because once the market reveals its intention, the move becomes much easier to follow. And here's the key idea I want you to remember: the market doesn't move just to go up or down, it moves to where the most liquidity exists. And once you understand that, your entire perspective on trading starts to change. So now I want to ask you something. Do you think gold breaks higher from here, or does it drop first, trap traders, and then move up? Let me know your view in the comments. And if you want analysis that actually explains what's happening, not just headlines, make sure to subscribe, because in the next video I'm breaking down Bitcoin using the same approach. And based on current market behavior, that move could be even more explosive.